Hello, everybody. Welcome back to another episode of the Loan Officer Playbook Podcast. Today, I'm joined with Coby Hakalir. Coby is the Director of Mortgage Banking and Technology at T360. Coby has been working in the mortgage industry for over 28 years. And get this, he started working in mortgage when he was 19 years old. That's a lot longer before I even started working in the industry. And one of the things I like about Coby is he has some of the most contrarian but also interesting opinions about mortgage lending and technology. And I'm really excited to have him on the podcast today. Welcome, Coby.
Thank you, Michael. I appreciate it. I like to think my opinions are not contrarian for the sake of being contrarian, but because I've got just a lot of years in the business and my perspective is just different than most because of that.
Yeah. I think one of the things that actually attracted me to you, and I would imagine vice versa, was your predictions on LinkedIn. So you do these predictions about what's going to happen in the industry. So when everyone's like having like some herd mentality, thinking one way or like rates are going to go down, and you're like, well, hold on, what if they go up? Yeah.
Yeah, it's a little early to call me right about that one, but it certainly seems like it's trending in that way. And I didn't want to be right about that one. It was more to say, hey, you know, we have to look at things in our industry and be realistic about them. And one of the things that we need to be realistic about is that we really don't know where rates are going to go. So many things impact them. If you had asked somebody in January of 20 or December of 2019 where they thought rates were going to be in 2020, you would have gotten a lot of answers that they were going to be somewhere in the 5.5%, 6%, range at the top, maybe even as low as 4.5%, right? Lo and behold, within the first quarter, we had the pandemic and rates were, at historic lows. And so I wanted to come into this year with that same mentality saying, hey, we have a pretty wild administration about to take office. And there's a lot of discussion from them about how they want interest rates to be low, which nobody's ever going to say they want them to be high, but they're also touting a bunch of economic policies and political policies that may take things the other way, and we've seen so far that is potentially the case. So we could still recover from that, and we could still see things shift, but as of right now, it doesn't look like we're anywhere going to be anywhere near the 5% mark that a lot of people were hoping for, but still hoping for it.
Yeah. And we've been in, higher rate markets before. I think that's one of the conversations that we had earlier on when we had lunch a couple of weeks ago. Can you tell me more about, how would you relate higher rates in the 70s as opposed to potentially higher rates in the 2020s?
Yeah, so my personal perspective doesn't go back that long, but I can tell you that one of the biggest differences between having rates when I got into this business, rates were about 7% for the 30-year fixed, and shortly after I got into this business, rates were starting to dip into the low sixes and high fives, and we had a little bit of a refi boom, and so it was an interesting time. But what the difference between now and then, are two things. One, the 7% interest rates today are coming as a shock versus what the rates were the previous 2 years. And so when you've got people that saw rates, they didn't buy, obviously, they were still renting or they were, thinking about buying. And they saw rates go from, 2.75%, 3% 30-year fixed to more than double that. That sticker shock put a lot of people on the sidelines. Put aside the housing inventory issue completely for the moment. It's that sticker shock that's one difference. The second big difference is in housing prices, right? We've seen housing prices, go through the roof essentially. And that housing price exponential burst has been coupled with wage stagnation, right? We're not making as much as a society in terms of our salaries and our income as we were relative to the price of a house 30 years ago, and certainly not 50 years ago. And one of the things that illustrates this point, I think pretty clearly, is that in 1975, the average age of a first-time home buyer was 28 years old or 27 years old, something like that. Now it's closer to 38, 39 years old. So we've actually made owning a home in this country more elusive and not more easy, which is a complete failure on the part of the housing industry to actually make it harder to buy a home when you're younger. Because as we know, buying a home is the quickest antidote to compiling generational wealth and really having that rainy day money put away for retirement. And so that's even put that so that failure is now putting even more stress on people that are in the market because they need to buy something. Their timing to build that equity is less than it was. And so we've done a terrible job of making homes affordable in this country. And with all of the first time buyer programs and down payment assistance and the mandates by the federal government to institute first time buyer programs, we have failed in pretty much every way.
Yeah. I think also the media plays a role in that too, because the media tries to mystify rates going up. When I open my Instagram feed, I can tell you the amount of rates are going up. Don't buy now. Buy in 2 years. Or like do this, do that. Why had the conversation in the media just moved towards polarizing topics because it's very binary. It's either rates are going up or rates are going down. And then if you take one side, then you're alienating the other half of the slides. Like what role do you think the media has to play in terms of home ownership and letting more people buy homes?
Well, I think the media has to be called out for what they are, which are they're a business, and their business is to sensationalize the topics of the day and make them as polarizing as possible. Um, as we know, doom and gloom sells a lot more than good news, right? And so that's the reason you turn on the news at night. And the first thing that you start with, if I was born and raised in New York City, and I remember the 6 o'clock news coming on, and it always led off with, a murder, a police officer being shot, a high speed chase. Same thing when I lived in Chicago for a long time. And no different now that I'm living in Northern California. Where we tend to, the media sensationalizes bad news and doom and gloom. And by the way, that's part of the reason why Donald Trump got a lot of attention when he first was running for president in 2016. He got a lot of media attention because he went on TV every day and talked about how terrible this country was. And so the same goes for interest rates. When you have, and that's not to be political, that's just me stating a fact, by the way. But when you have interest rates, and the media is certainly going to take the position that rates are going higher, homes are unaffordable. Gen Z, millennials, Gen Y, whatever generation that they're appealing to that day can never afford to buy a home. They do a whole study, and a whole article about, John X, who's a millennial who, is living in his parents' basement because he hasn't gotten a raise in 15 years and says, I can't buy something because rates are at 7 and not at 6%. Is that factual? No, but it makes for a good story. And, a good story in the media they don't like that to get in the way of the facts. So I don't think the media plays a role in reality, but I think the media plays a role in terms of our cultural attitudes towards home ownership. The media has given off has put forth this image of home ownership as being completely elusive, unattainable, and something that the younger generation, simply shouldn't even try. And I think that's wrong too, but I can't fault them for doing their jobs. I think we need to do a better job as an industry of changing the narrative.
I can just see your passion when you were talking about the lending industry, and maybe that just stems from, you working in it from when you were 19. So it's actually very personal to you. Can you take me back to when you just got started? This 19-year-old kid in New York, just getting started in the industry. How was it like for you?
I had a rough first couple of weeks, and I'll tell you two stories that'll illustrate my rough couple of weeks. So the first day that I was working for a bank called Fleet Mortgage on Long Island. Fleet was a pretty big regional bank up and down the Eastern Seaboard, and I decided they had hired me, and I was going to go to the office and I was going to wear a tie. And at that point, people came to the office wearing suits and ties. That's just how you did it. And within about 10 minutes of getting to work, I spilled some coffee on my tie. And this is my first day, 10 minutes of my first day. And I was, more than a little shaken up. I was like, oh no, what do I do? Do I go back home? I lived about 40 minutes away. So I took the tie off and put it in my drawer, where it stayed for the entire 2 years that I worked there. Now, other people came into the office and they saw the new guy. Not only was I the new guy, but I was also 19. So I looked like, a child to them. And I wasn't wearing a tie, and they thought that that was some sort of statement I was making, that the rest of you are going to wear ties and I'm above it because I'm too cool for ties. So that was my first day. I had to overcome this, hey, this kid's too cool for school. The second thing I did, I think that was my first or second week, but it was early on, and this goes to my contrarian nature. We had a comp plan where you would get paid a certain rate for refinances, but if the refinance was a loan that was owned by fleet, they paid you less. They consider that to be a fleet to fleet refinance. It was an inside refinance, and they paid you less because they thought that the opportunity was easier for you to attain because it was already company owned business. I had the opposite argument. I said, this is business that if we don't go after, someone else is going to take it from us. And you should pay us more or the same as the other refinances because we're helping fleet retain business. And retain business is always cheaper than going out and getting new business. This is what we should be focused on. Well, I went to my boss and my boss didn't agree with me. And he said what I later realized was flippantly, take it up with the CEO. So I, not knowing that that was a joke because I really had never had a real job before, I emailed the CEO of Fleet Bank. And he responded pretty forcefully within a couple of days, basically saying, who the hell are you and go do your job and please don't ever email me again. So that was my first couple of weeks in the business.
Oh my God. That must have been, a rough couple of weeks coming in. First of all, you had the issue with your ties, which I think now it would be nothing because like kids nowadays.
Well, you wouldn't even show up. You'd be working from home, right?
Exactly. So it's like night and day. And then the issue with you coming in with I think your argument was potentially actually very correct because if it's an internal refinance, of course it's easier because the customer is already with you guys, but it's business that you might be losing if you don't put as much effort into it. Yeah.
Yeah, I still maintain I was right almost 30 years later, just FYI.
Has that policy changed at all?
To some extent, some banks have streamlined the way they pay things, but for the larger extent, no, they will still pay less for inside refinances. It's just something they've always done and gotten away with, so they'll continue to do it.
I think MLO compensation is also a pretty hot topic that I'd love to get your opinion on. We've seen. I was on Reddit the other day, and someone was trying to get a loan officer job at a bank, and then I think it's like R/loan originator, and then they were talking about how many basis points they were getting, and I think it was a loan partner job, and then they were getting I think like 80 basis points or something, and then someone was like, "Oh, 2 years ago when I started, I was getting 150 basis points. You should just totally drop that job." And I've talked to a few people where loan officer compensation has been moved from, let's say, having a commission based structure to, let's say, a sales based structure or even a salary based structure. Like a lot of people are innovating in the way loan officers are compensated. I'm wondering, what are some of the innovations that you've seen in LO compensation? What are some of the things that you think about?
I would be hard pressed to share the use of the word innovation with you. I think I think innovation speaks to progress. I've mostly seen regression more than progression when it comes to LO compensation. And that stems from a lot of things. It's not for lack of value that companies put in loan officers. It's from the pressures that are there from other expenses, right? For example, the average amount that was spent on a loan from a percentage standpoint prior to the Dodd-Frank Act was about 5% of the loan's budget was for compliance, right? That number is now 25%. So when your margins are compressed and it costs that much more to do a loan, somewhere in the $15,000 to $17,000 range right now per loan, of course you're going to go to, what are the levers that I can pull to reduce my cost of doing business? And the loan officer has suffered greatly from that over the past 10, 15 years. What I think we should be doing, rather than de-incentivizing salespeople who are the most important arm of any mortgage company, is we should be looking for ways to cut the cost of doing business. That's where companies like yours come in. Companies that actually can help workflows, automate, integrate, do all of the things that we need to do to make this business cheaper on the other side. Regulatory oversight is going to be what it's going to be. It's going to ebb and flow. I think right now we're going to see a major ebb in the next couple of years. And then after that, we may see a flow. So I think trying to count on that being a consistent fixed cost is impossible. But I think where you can control fixed costs by controlling some of the workflows and being a little bit more deliberate and intentional with how you spend money and how you do things, I think that can ultimately allow you to keep margins at a rate that's acceptable and pay your salespeople what they deserve to be paid. I don't think a loan officer should be paid any less today than they were paid 20 years ago. In fact, I think they should be paid more because it's harder to do a loan right now than it was 20 years ago.
I think what makes you think it's harder to do a loan right now than 20 years ago? Is it due to like regulation because it's all of the regulatory practices?
Yeah, I mean, 20 years ago, if we're talking about 2005, 2005, and this is not, I will always contend that yes, the mortgage industry had some hand in the Wild West days, but a lot of that was from Wall Street and what they were willing to purchase on the secondary market. But it was so much easier to do a loan then because there was nowhere near the regulatory and compliance standards that there are today. The guidelines were more expansive. It was a lot easier to get people through with different kinds of credit, different kinds of income. I'm not saying we need to go back to what that was, but it is harder today to get business. It is harder today to get business closed. There's a lot more moving parts around it. There are a lot more rules around it. And so I don't think that translates to loan officers getting paid less for their time.
And this is where technology comes in because if it's a purely time-based decision, then you can say, well, you can use technology to alleviate some of that time while the LO goes to interface with the customer more. Don't you think?
I think there's a lot of good uses for technology in the business. I'd love to see the mortgage industry spend more on technology. And I think that 80% of companies in a recent survey, don't quote me on which survey it is because I don't remember right now, but it did say that it was a viable survey. It was that 80% of companies intended to spend more on technology in the next year or two, which I think is great. The biggest problem is not the spend, it's the integration. We have a lot of antiquated technology out there. We have one vendor dominating a huge amount of the space when it comes to the loan origination software. Opening up that software to make it easier to API into, I think, is a big first step. But I think we also need to kind of figure out how to muddle through all of the different workarounds that companies have put into their technology to keep things compliant, to keep the reporting where it needs to be. That's what really drives the cost up. And that's really the biggest hurdle to integrating new technology into the workflow.
Integrations are hard. I feel like everything that we do, when I talk to customers, I say we're an integrations company because they're all using different workflows, different software, and then our AI software would work better if it's integrated into all of their different CRMs. Like I once talked to a mortgage company that spent a whole year deciding what CRM to go with. And that absolutely makes no sense because that should be a decision that should be very easy to make, and then integrations should be readily available where all these computer systems can talk to each other, and that exists in some industries too. I wonder why is there, as the director of tech at T360, and you've seen many and many of these deals being done, being in these conversations. Why is there a gatekeep culture for integrations in the mortgage tech space?
Well, because of all the different stakeholders. You've got a lot of stakeholders. The loan has to go through so many phases. And each of those phases have different demands on them from the stakeholders in those phases. And so you've got to get buy-in from all these different folks to say, okay, this works for my department. This doesn't work for my department. Here's what would work. Here's what won't. And then on top of all of that, you've got your frontline, which are your loan originators. And if you can't get them to adopt and implement and work with the technology you're giving them and be able to explain to them how it's going to make their day better, then you're going to have a lot of pushback. You're going to have a lot of pushback pre-implementation. You're going to have even more pushback post-implementation. And now you've spent a whole lot of money on technology that nobody wants, nobody knows how to train on, and nobody wants to use. And so I think that it's just an inherent part of the business that it is complicated. But I don't think complication should stall progress. I think the progress, it's okay for it to be slow as long as you're moving in the right direction. And what I tell mortgage companies that are looking to implement new technology is keep the end user in mind. Not how does this help your post-closing department or your funding department or your processing or underwriting or even loan officers? How does this help your customer? If you use the customer as your North Star, and how does this make their user experience better in working with your company, then you can turn around and sell this to everyone in your company by saying, hey, what is it worth to you as a salesperson, as an operations person, to have a happier customer, get through our process faster, and then turn around and refer other people to us versus having somebody stumbling through a clunky process, that then gets upset. The realtors don't want to refer business anymore. The customer's pissed off by the time they get to the closing table, and it makes it that much harder for you to go out and get repeat business from either the referral partner or from the customer themselves.
And that's even more like an art more so than technology these days. Like tech is super easy to build. It's um, how well do you streamline the customer experience? You say, oh, hey, well, these are the bottlenecks that the customer goes through. Like, how can we get feedback from the customer? How can we iterate? Like, how often are these systems, being updated? I don't see like that many updates. Like, if something's wrong, it takes like a couple months before they're updated. Um, and to your point too, everyone is just trying to work in a different sector of the stack with the stakeholders. I saw this PDF from LMA a while back that listed the, the systems that a loan goes through until closing, and it's like it goes through over 100 different different systems. From like an application, the POS and the LOS, it goes through title, underwriting, desktop. Yeah,
If you want to, if we've not only made buying a home more elusive for people, but we've made the process of buying a home much more elusive for people. And another argument for keeping loan officer compensation high is because they're the person representing your company as the borrower goes through this maze of regulatory compliance and recertification and uploading documents and writing letters of explanation for things that don't really make sense in the real world. There's so much that goes on in the land of mortgage that does not go on in people's real lives. And until those things are actually in alignment, you're going to continue to have a clunky process that makes no sense to people and is set up from the start to create friction. And that's really what we have. We have a process that creates friction from the get-go, and managing somebody's expectations becomes the most important thing you can do versus actually providing them with guidance and education along the way. And I think that's another failure of the mortgage industry, to not figure out how to really relate to the customer and adapt to what happens in real life. And that comes all the way from Fannie Mae and Freddie, with their guidelines that make almost no sense in so many facets. We need a complete overhaul of that as well.
where do you think it provides the most friction in the process? And where can technologists like you, me, other people go build in order to reduce friction?
I mean, I think there's a couple of different ways to attack that answer. If you're talking about it from a credit approval standpoint, we need to do a better job of aligning what the credit standards are of the industry with how people actually live. We need to make sure that we need to make sure that people are actually, people are getting paid now and they're making income in ways that they weren't 10, 20 years ago, right? We have a gig economy, people that have side hustles, people that are doing all kinds of different things, and we're telling them that their income is not necessarily viable. We need to figure out a way to align our credit standards with how people are actually living. For example, the way that people save money and how we question those deposits in bank statements, the way that people file their taxes, what they claim versus what they actually make, and what they deduct. We need to figure out a better way to do that. And if you ask the average loan officer to explain to you how they go through a tax return and derive income from those tax returns, if you ask 100 loan officers, you're going to probably get 97 different answers. Right? That's a problem. And we're not doing a good job of educating those loan officers on how to read through those tax returns. And the rules that are behind them are archaic. So that's one point of friction that I think would, grease the wheels quite a bit, so to speak, right? The other way that you could reduce that friction is by making the technology a lot more accessible to people, right? If we've got an average age of a first-time home buyer of 38 years old, then we have to figure out, what is that 38 plus customer, what are they comfortable doing? What do they understand how to do? Is it a downloadable app? Is it a web link? How do we get them how do we explain to them which documents we need and what information is needed? I've seen some companies do a pretty good job with that. I won't name names to the exclusion of anyone else, but I've seen some companies attack that issue from the right way. Those companies are winning with better customer experiences. Did they solve the rest of the clunkiness? No, but it's a start to at least make the process feel somewhat intuitive.
You said if you ask 97, I wonder if it was 97 or 99 different loan officers how they calculate income, you'll get 97 different answers. And I bet you, if you ask the same loan officer a second time, you would get two different answers because the income calculation it changes all the time.
It does.
Yeah,
It changes all the time, and not to the side of simpler.
exactly. I was talking to a loan officer yesterday, and then they sent me their income calculation sheet, and then they were like, "Oh, this is one from 2 weeks ago. Now this is the updated one." You know? Like, if things keep changing so much, like it's making it difficult not only for the loan officer but also for the lender, but ultimately for the customer. Because if you're a nurse, you're a travel nurse, and then you made 170K last year because you worked on December 25th when your pay is like three times higher, and now you don't make that much. Like all of those different scenarios. How do we streamline all of that? If you have any
I
thoughts.
think we need better technology, and I think we're trying to do that with some of the credit scoring updates and some of. But I think we need more competition in the space. We need better scoring models on the credit side, and we need technology to help us figure out who's really a risk and who's not a risk. And I think if we can implement that, we can do two things. One, we can make the process a lot more seamless. We can have a lot more people qualify for loans, right? Which is a good thing. Even though we've got an inventory issue, we'll build homes. We'll figure that over time. I'm pretty confident of that. But we need more buyers that are in the marketplace because that strengthens the entire marketplace. The second thing it'll do is it'll take some of the inherent biases out of the mortgage equation, and hopefully that can lead to less oversight and less regulation. If we're having a machine learning, if we're having a machine actually tell us who's a credit risk and who's not a credit risk, and take some of that out of the human in the loop, and say, okay, well, the machine made this decision, and we do some of that today with Fannie and Freddie. But if we can get to a higher plane of that, I think we can actually invite even more borrowers into the marketplace, and we can do so in a way that's not to the exclusion of any one group that then requires regulatory oversight to re-include that group into the mix. So I think we can do a lot if we look at things from a more common sense perspective. Like you said, the traveling nurse, or the seasonal worker, or somebody who's working three side jobs at once and has been doing so for a while. We have to figure out who should own a home and who shouldn't, and I think we can do a hell of a lot of better job in that, because I've seen in my years many people who deserve to buy a home, who should be homeowners, who would be great candidates for lending from any bank, get turned down.
That's where the overall economy is moving to with gig workers, social media influencers. If you have you seen this article of high school kids, like the number one most popular job that high school kids want to do? If you ask a high schooler, they're gonna say they want to be a YouTuber. You know.
I've got a 10-year-old here at home who will give you that same answer.
Exactly. And so look at them 10 years from now, they're a YouTuber, they're making variable income. 1 month they get 20 million views, the next month they get 5 million views. Are they going to be able to afford a home in this current model? Probably not, but they probably make as much, maybe if not more money than someone on a W-2.
Yeah, where I'm excited, for where I think the mortgage industry can innovate. And first of all, I love what you're doing with guidelines, because I think that's super important to be able to break that down. Not to give you a plug, but this is real honest feedback. I love what you're doing. It's why I reached out to you in the first place, because I think loan officers should have a better portal for being able to figure out the guidelines and how to then take those, distill them, explain them to borrowers. That's a major pain point that you're solving. So kudos for that. As far as innovative products, though, I think one of the things I'm excited about, I'm hearing things about it. I haven't seen the product. It's probably going to take years for it to be implemented. Is this idea of, okay, if we're not going to pay people more, right? If we're going to still have this wage stagnation, but housing prices are going to continue to go up, how do we get more people into homes? And the shared ownership, those innovative programs of actual 4, 5, 6 people buying, 1/6 of a home or 1/5 of a home, and all moving in together. So instead of roommates renting, now you have roommates that are actually buying and then being able to sell their share when they leave, right? Well, that's definitely a first step towards solving the affordability crisis, is by cutting up that pie and making each slice a little bit more affordable. So I'm very excited about some of the things I'm seeing in that space. I'm seeing some lease holdback programs that I think are interesting. The problem with some of those is they're a little bit too complicated. Um, in terms of working with the guidelines as they are now. So, I think we need to keep innovating. But I don't want to see the innovation be, hey, we're going to pay loan officers less, and now the and now the mortgage is so much more affordable. Like, hey, what a great invention. I think we need to be a little bit more keep the customer, keep the end user as the North Star. Is my
I've seen a few good fractional ownership products. I don't want to give anyone a plug, but I think that's great. And I like the way you think too, because it's like, okay, everyone's thinking about, well, how do we get the cost of sale down, but not on the technology side, but how do we undercut loan officers? Like that's what people are thinking. And then you're like, no, well, how do we make housing more affordable for the customer, and how do we get more people owning homes in fractional ownership? And this is not something that I've heard a lot about. I've seen it around, but it's not something that someone's actually actively thinking about as one of the ways to solve the home ownership problem.
Yeah, I think there's a lot of people that are in that space trying to think about that issue. And I hope that they gain traction, and I hope that they gain a partner in Fannie and Freddie to be able to implement some of that, so that these are, saleable loans from the average lender, that they can actually go out and promote this product because they know that Fannie and Freddie is going to buy it on the back end. So there's a lot of work to be done there, but I think we need to approach the problem from a different angle, other than hoping rates go down and hoping all of a sudden we have 4 million new homes hit the market. I think the first one is failing to plan. I think the second part is just wishful thinking that is not likely to come true.
Do you think one of the ways we do that is by incentivizing a bunch of smart people to come work on these problems? Just getting new blood, if you will, into the industry and new thinking.
100%. I think that is going to also take really demand from the mortgage industry, right? So the mortgage industry has to put out that demand and say, hey, we want these products, we want these innovations, and the smart people will follow and work on them. I mean, that's why you kind of got in. You saw that there was a problem to be solved, and you went after it. And I think that the more we talk about that, we want to solve it, and we want to use technology to solve it, the more people will come and try to do that. I think that's just, if you put out the fact that you have a problem, you're going to have smart people come and try to solve it for you. But you've got to then turn around and adopt those solutions. You can't just say, well, that sounds great, but there's no way I can do it because, Encompass won't let me integrate this into my workflow, and I have no idea how to do it. And my two IT guys, have, made 100 workarounds that you're going to have to now work around when you try to integrate anything.
So you came to a hackathon. Thank you so much for doing that. And in that hackathon, you can actually see how disconnected the mortgage industry is from educating technologists, because we had some of the smartest people, but then we still had to educate them about how a loan is closed. They had no idea. Our co-host, Brett from Lender Toolkit was there, just educating AI engineers that, hey, this is how underwriting works. This is how income calculation works. This is how application works. What even is a POS? What's an LOS? And you had this, excuse me, you had this post in December last year about how should the mortgage industry recruit talented people. And you mentioned the industry has an age problem. I'm curious, what are your thoughts in recruiting new talented people to work in the mortgage industry, and how can lenders and technologies, how can leaders invest in that?
Yeah. So first of all, thank you, and yeah, that was a fun article to write. I think what I was talking about in that article, and I'll address your question because it's really a two-parter. Although you may not have known that, but what I was talking about, we're getting new loan officers into the business. And if we're not getting new, and I think that's one of the reasons why we're seeing that average age of home ownership go up, aside from the problems that I illustrated earlier, is if we're not bringing new and younger loan officers into the business who speak the same language as the younger potential borrowers, then we're missing an opportunity there. We're not connecting with an entire generation of folks. And so what the other problem that we're encountering by not bringing younger people is younger people typically drive innovation, and they drive demand for better technology. We see that a lot on the real estate brokerage side, where young brokers come in and they demand better AI, and they demand better scheduling and virtual tours, and we see that demand that comes from the bottom up, right? if all it is coming from top down, the push isn't there. The desire to implement isn't there. If you hire a younger workforce, right, and that desire comes from the bottom up, I think then to the second part of your question, you're going to see the demand for technological innovation rise, and you're going to see a push for further innovation on the tech side and more people coming in. There is the number one lender right now in the country, is not a big bank, but it's actually a broker, and they have their own tech team of I think 15 or 1600 IT people. And if you look at the average big bank that has 100,000 employees, they may have that size of a tech team, but that working across all aspects of the bank, not just mortgage. And so when you have a dedicated team that big working on solving mortgage, they have the best tech out there. They're the number one lender for a reason. They've made a commitment to be the best in technology, and the receipts are there to show that it's working. And by the way, they're also hiring younger people. So it's not a theory that I'm putting forth. There's an actual example, and it's not an example of an up and coming company. It's an example of the top company. So if you're number 5 or number 10 and you want to know how to get to become a bigger player in mortgage, just look at the top of the mountain, man. They're doing it, right? They're building terrific technology, and they're hiring young people, and they're building a culture that is dedicated to winning.
I talked to someone from the top of the mountain yesterday, and they were like, "Oh, we hate documents. Like, we're trying to do all these things to eliminate uploading physical documents by just grabbing it from ADP, all these different places." And that's because they have young tech people who are thinking around that, and they're closing real fast.
They're closing as fast as the laws will allow them to close, right? Because we have some laws in this country that are the maniacal TRID law that requires people to wait 3 days from the time something's disclosed till they can close. I mean, absolute nonsense. But so the reality is you should be able to close a loan in 24 hours. You should. There's no reason other than we've never done it to not do it. And now, and if we repeal TRID, which I hope they do at some point, you will be able to close a loan in 24 hours. If you can buy a car in 2 hours that you can drive off and then drive right into the ocean, and nobody will ever find, why can't you buy a house in that same amount of time that's sitting right there? It doesn't make any sense, especially now that we have all these great automated valuation models. So we don't need to wait and send an appraiser out there. We can pull title in 15 seconds. All of this can be done. I think you should be able to walk into a mortgage company on your lunch break and come back at the end of the day and sign your paperwork and get your keys. I think that's the goal we should strive for.
I hope other people and leaders in the industry agree with you, because that's how you make real change. Is how can you get something that the borrower feels? If the borrower applies for a loan and then gets approved really, really fast, and then they feel that, and then they go tell their friends, or it then becomes, if you're going to the dentist, I don't know who made this analogy. It feels like buying a home feels like going to the dentist. No one wants to go to the dentist. You have to make it feel enjoyable. Feel like
buying a home is much worse than going to the dentist. Do you spend 4 weeks at your dentist's office?
No, I don't.
Exactly.
That would be the worst dentist ever.
Well, there you go. Yeah, I mean, we're pulling teeth for 4 to 6 weeks as opposed to 1 hour. So yeah, I would contend that it's much worse to buy a house than go to the dentist.
That's a beautiful way to put it. We're pulling teeth in 4 to 6 weeks instead of in 1 hour. Yeah, Coby, this is why I love talking to you, is because you tend to say the quiet part out loud, and then you say it with conviction. And speaking of conviction, you had this article about your predictions for 2025. I wanted to ask you, what are some of the things that you mentioned in that article, and what are the convictions that you have behind it?
The article was a mix of the perhaps to the not very likely. And it was more because I think those are conversations that we should be having, right? And so one of them was about interest rates, and we had already touched on this. And what happens if interest rates go up to 10% instead of coming down to 5? And right now the arrow is pointing in the direction of me being more correct on that than more wrong, right? Again, not that I want that to happen. I talked about the mortgage industry becoming more innovative, and you'll forgive me if I leave out one or two. I know there were 5, right? Being more innovative when it comes to the gig economy and figuring out how to approve those borrowers. I think there was one about mortgages in space. And there actually is some talk about, getting deeded land, out in outer space, because space travel is coming. And I think that, if you were in, and I don't know that it's coming in the next 10 years, but, if you were in 1945, post World War II, and someone was talking to you about landing on the moon, um, you'd find very few people who would say we're going to accomplish that in the next 25 years, right? And we did, right? We did it in 1969, less than 25 years after the end of World War II. So this idea of us actually owning land and traveling regularly to space, I can see that happening in the next 25 years, right? I mean, if you look at the tech innovations from 2000 to 2025, from 2025 to 2050, I think you could see just as big a leap, if not much more exponentially, right? I don't remember what else I talked about. There's one I'm leaving out in that article. But the bottom line, if I'm leaving out one or another, the bottom line is that I think there's bigger conversations we should be having about the future of this industry, the future of the housing market, and really thinking about what the next iteration of it is going to be. And part of that is hiring younger people, right? Because right now, this mortgage industry is still run by the same people that were in charge when I came into the business, right? Some of them are, retired now, but, and some of them are, around my age or a little bit older. But, one of the things that I've always liked to kind of joke around about is to say, when I came into this business, I was the youngest person in the office, and that still hasn't changed. Up until this day, I'm still the youngest person in the office. And at 47, I should be amongst, the elder statesmen that, with new blood coming in, that are pushing for change and pushing for new product and pushing for new technology and pushing for new ways to get their friends approved for mortgages. And I had, in that article that I wrote previously about, bringing younger generation in, there is some of that going on. And I interviewed in that article a young 22-year-old named Brian Lavelle in New Jersey. And Brian, got into the business only because his uncle happened to own the mortgage company that he works at. And it's no knock on Brian. The kid's, getting his master's degree, and he's super intelligent. But one of the things he told me was that no one came to his college to talk about the mortgage industry as an opportunity, whereas almost every other industry came and at least said, hey, this is why you should be in this job or that job. Mortgage never showed up. So if we're not a part of the conversation and not a part of the culture, we're certainly not going to ever adapt to where the culture is going and be able to innovate to where things are going to be, right? We need to skate to where the puck is, not to, or the puck's going to be, not to where it is right now. And we're doing a terrible job of that, and we need to get a lot better.
Put your article in the show notes. So for the audience, all of Coby's articles, the ones that we talked about in the show, are going to be in the show notes, so you can go ahead and check it out. But you make an interesting point about, first of all, not recruiting younger people, but also one of the only ways that younger people can get in is if they are directly related to, the person who owns the mortgage business. One of the things I like to say is like, no 22-year-old wakes up and says, oh, I can't wait to go disrupt the mortgage industry. I just can't wait to go do it. And when you first joined, was the mortgage industry hot when you first joined?
No, I got in through, my mother worked in the industry. So, I'd already had some, entree into that. So the reality is I started working in the industry when I was like 14, because I would go to her office and help her package up FHA files to send to Atlanta. Back when, you had to actually mail files to a regional underwriting center to get underwritten. I mean, talk about antiquated, but, that's what it was back in the 80s. So I'd had exposure to the mortgage industry. And I understood, kind of what it was, even though at that point I had not even rented an apartment, let alone owned a home. And, it appealed to me because, I thought there was something noble in it, right? I thought there was something noble in helping people with that experience. And some of my first clients were, people, my cousin, I helped her buy a condo in New York City, and it was her first ever place. And, and I thought it was a pretty cool thing to do. I had younger people in the office then. They weren't as young as I was, but there were a bunch of people in the office then that were in their early 20s, and they were making good money and they were excited about it. And over time, I stopped seeing that energy and that exuberance. And it started to just become this older generation that was in the business. And it's strictly because we stopped telling the story of what a cool business it was. We just didn't do the job. And then come 2008, 2009, 2010, we let the media do that for us and destroy us. And that's pretty much what we've done since then. Is just we've sat back and just taken beating after beating in the media, and the federal government. Every time, Elizabeth Warren's been yelling at us, and that's been going on now for, forever, and she's still doing it. God bless her. Keep rolling, Elizabeth. But we have done a terrible job of talking about what a great industry we are, and what our vision is for the future.
I 100% agree. I think the industry has a branding problem. It has a sexiness problem. So I just turned 25, and I started working in mortgage when I was late 23. And when we were doing this hackathon, we were looking to attract folks in that age range, and the biggest problem was how do we make it attractive for them? Like, and we almost decided to, well, we did call it a mortgage, an AI finance and mortgage hackathon, and we branded it with finance, executing trades, and then we just slipped mortgage right in there. And once they came in for the finance, it's like come for the finance and stay for the mortgage. That's what we did, and that's one of the ways we were able to attract them.
I appreciate that. I
Amazing.
can't wait for your next event. I plan to spend a lot more time there than I was able to this time, but I'm very excited for that.
I will share it with you. Amazing insights here, Coby. Uh, so before I let you go, I feel like I can talk to you for hours and hours and hours and get as much interesting ideas as possible. And all of the people who are watching, I think they're technologists here. They should just go read your articles and find ideas to work on. Like for like 5, 10 years, those are the ideas that are going to be mainstream. Um, how should the audience reach out to you? How would you want people in the audience to get interfaced with you?
Easiest way is LinkedIn. I'm on LinkedIn all the time, as you know. I'm a chronic poster. As I my daughter I asked my daughter if she knew who was playing in the Super Bowl, and she identified the teams. And I said, "How did you know?" She doesn't watch football, and she said, "I'm chronically online." So with LinkedIn, I would say the same thing. I'm chronically online. I love being on that platform and communicating. So find me on LinkedIn. You just search my name. I'm the only one with that name. And I'm happy to talk. I love having conversations about the industry.
Amazing. Kobe, thank you so much for coming on. Hey, everybody. This has been another episode of the Loan Officer Playbook Podcast. This has been one of the most action packed and insightful episodes ever. So kudos if you stayed this far. If you're a technologist, go listen to other podcasts that Kobe has been on, go read his articles, and then get as much ideas. If you're a leader in the industry, take Kobe's ideas, such as hiring young people, investing in technology, and not undercutting loan officers. Pay loan officers their fair share, pay loan officers what they're worth, and don't innovate by regressing backward, innovate by progressing forward. Thank you so much, everybody. This has been another episode of the Loan Officer Playbook Podcast, and I'll see you in the next one. Bye bye.